Apart from the ones about vaccinations and COVID cases, this could be the most important economic and investment chart of all at the moment. And that's because the key issue for investors is inflation. Is it happening or not? And the fact that firms are refusing to pay higher wages, even though they can't get staff, is a big change to the way the world works. If that goes back to normal, so that a tight labour market once again leads to inflation, then interest rates will rise earlier than expected and markets will fall, possibly crash. If not, and this strong economic recovery continues to be accompanied by stable prices, then it's happy days. Inflation is starting to rise, but central banks think it's temporary. Last week, the US Bureau of Labour Statistics reported that American inflation had shot up to 4.2%. At this point in Australia, inflation remains low. But that's about to change because of what's known as the base effect. The Consumer Price Index fell last June, so that this June it's coming off a low base. Analysts reckon the next inflation rate in Australia will be 3.7%, maybe more. Companies around the world are reporting that they're seeing supply bottlenecks and rising prices. The other factor in Australia is the collapse in migration, which is improving workers' bargaining power since employers can't simply bring people in from overseas to replace them. Personally, I'd like to see inflation stay at 1% or so. In fact, price rises of 0 are fine with me, but central banks are obsessed with getting it up to between 2 and 3%. Why? Well, because if prices are rising, consumers tend to buy now rather than wait. And also because inflation tends to reduce the burden of debt. And debt is something we've got plenty of right now. The problem for investors is that the record of central banks in finessing economic outcomes is not great. Things have a habit of getting away from them.